The stock for Opendoor Technologies Inc., NASDAQ:/Open, is currently trading at $7.41, reflecting a decline of -1.60% on the day as of 11:03 a.m. GMT4 on October 13, 2025. This downward intraday movement might seem like a simple pullback after a period of intense volatility, but the deeper reality here isn't just about market noise. It's about a fundamental, strategic race against time. The unexpected angle is this: the market is currently caught between the old financial model, which the stock's prior performance reflects, and the promise of a completely new AI-first business structure spearheaded by a new CEO and the return of a co-founder, Keith Rabois. The real question investors should be asking is not where the stock is going today, but whether the new operational mandate to drastically cut costs and speed up transactions can take effect before the current housing market cycle truly turns against the asset-heavy model. That tension between the sluggish, capital-intensive iBuying reality and the narrative of a swift, tech-enabled turnaround is the central conflict in this stock's valuation right now. The common understanding, especially among retail investors active on Robinhood or using SoFi Invest to manage their online investment accounts, is that Opendoor is a high-beta stock, prone to massive swings. They see the year-to-date performance, which was up over 400% at one point in 2025, and remember the massive spike following the announcement of the new leadership and the emphasis on artificial intelligence. This surge, fueled in part by high short interest creating a short squeeze potential, established the expectation that this stock is primarily a momentum investment, tied more to sentiment and the AI story than to underlying housing market fundamentals. However, the reality, as evidenced by the recent price action and the downward trend since the September highs near $10.87, is far more complex and grounded in traditional high-interest rate macro pressures. The last reported guidance for Q3 2025 was a severe disappointment, with a projected revenue of only $800 million to $875 million, substantially missing the prior consensus of around $1.5 billion. This isn't just a minor miss, it reflects a sharp deceleration in home acquisitions and sales, suggesting that the company is still heavily exposed to the slow, high-cost reality of a tight housing market. The leadership change is a massive positive catalyst, certainly, but a CEO's strategy takes time to translate into financial results, and the market is pricing in near-term weakness due to that grim third-quarter forecast. Looking closer at the recent stock movement, the decline today follows a period of extreme volatility. For example, on October 6th, the stock saw a massive swing moving between $8.05 and $9.65 in a single day, nearly a 20% fluctuation, which underscores its high-risk profile. The stock's price in the $7 range is now testing accumulation areas from earlier in the rally. Institutional data from Q2 2025 shows a mixed signal that captures this tension perfectly. Some major holders like BlackRock Inc. and Vanguard Group Inc. significantly reduced their positions, while others such as 2 Sigma Advisors LP and Cube Research and Technologies Ltd. aggressively added shares, suggesting a deep disagreement on the stock's intrinsic value and near-term outlook. This stock is not behaving like an Apple stock or a stalwart like Fidelity Investments mutual funds. It acts more like a speculative bet. The narrative of an AI-first platform to streamline home pricing and operational efficiency is compelling, but the hard, cold numbers of its legacy operations are a drag. Its previous profitability attempts have been fleeting, with the adjusted EBITDA profit of $23 million in Q2 2025 being forecast as a one-time event, with Q3 expected to return to a loss between $21 million and $28 million. For anyone managing an intelligent portfolio or looking for investment help, this stock requires a deep understanding of its capital-intensive nature, something often obscured by the high-growth tech label. To understand Opendoor, we have to look past the ticker. The company's core business model is iBuying, instant buying. They use proprietary algorithms to make cash offers on homes, close quickly, perform light renovations, and then resell the properties. The profit is made on the difference between the purchase price plus costs, renovation, financing, holding, and the final sale price. The speed of the transaction is critical because every day a house sits on the books, it incurs holding costs and financing costs, which are exacerbated by high interest rates. This is the structural flaw that caused immense pain in 2022 and 2023, forcing the company to pivot. In the current high-rate environment, where the traditional housing market is slowing due to low affordability, Opendoor is constrained. They must be much more picky about which homes they acquire, leading to lower acquisition volumes, which in turn explains the drastically reduced revenue guidance for the third quarter. They are consciously slowing the volume engine to focus on margin protection and operational discipline. The good news is that the Q2 gross profit margin was 8.2%, a sign that the per-home economics were improving, but this performance is already being overshadowed by the macro headwinds and the guidance for a sequential revenue decline, with Q4 revenue also expected to decline significantly. The strategic shift is all about moving towards a high-velocity, low-inventory, capital-light platform, potentially involving more service-based revenue streams like Cash Plus, which partners with agents. This move is a direct concession that the old, massive-scale iBuying concept is unsustainable in this macroeconomic environment. The recent flurry of activity also includes significant corporate governance changes that the market is clearly taking seriously, evidenced by the rally that carried the stock from its 52-week low of $0.51 up towards the $10 mark. The appointment of Kaz Najathian as CEO and the return of co-founder Eric Wu and the highly respected Keith Rabose to the board signaled a mandate for operational overhaul and cut costs, with Rabose specifically vocal about the need to dramatically slim down the workforce. The market is betting that the Silicon Valley operational discipline can succeed where the real estate operations previously faltered. This new management team is essentially being tasked with a high-stakes, real-time corporate restructuring while operating in a very difficult market. This is the lens through which you must view Opendoor stock. It's no longer just a housing play, it's a turnaround play with the housing market acting as a hostile environment. This complexity is why traditional analysts, whose price targets often rely on lagging financial data, remain exceptionally cautious. Consensus price targets hover dramatically lower, closer to the $1.14 to $2.64 median range, reflecting skepticism about the company's ability to ever achieve sustained profitability in its capital-intensive model. For investors who prefer to self-invest, using platforms like Fidelity or Interactive Brokers, or those with a growth focus, the upside scenario is clear. If the new management successfully implements its AI and cut costing strategies, achieves a sustainably positive unit contribution profit, and reduces inventory risk, the stock could re-rate significantly. The massive short interest, representing over 23% of the public float as of late August 2025, remains a loaded gun. Any substantial positive surprise in the Q3 earnings report, due out in early November 2025, or an unexpected optimistic signal about Q4's operational efficiency could ignite a powerful short squeeze that sends the stock flying past the $10.87 52-week high. However, the risk is equally clear. If the Q3 results confirm the grim guidance, or if the new strategies are slow to gain traction, the stock could retreat sharply as conviction wavers. The high total debt-to-equity ratio of 3.46 further emphasizes the leverage and the capital-intensive nature that the company must overcome. The market's anticipation of an AI-driven transformation is a strong psychological factor, but the reality is that home sales still involve tangible assets, interest payments, and the unpredictable nature of local housing markets. The immediate-term focus for anyone looking at this online investing vehicle should be on the technical levels. The recent dip today pushes the price towards critical support areas established during the last consolidation. A break below the recent daily lows could signal a test of lower psychological support, but strong volume at these levels would suggest institutional buying is attempting to establish a floor ahead of the earnings call. The stock is constantly in flux, making it a favorite for active traders using Robinhood stock trading for its ease of execution, but a difficult proposition for long-term holders accustomed to the predictable growth trajectory of something like NVIDIA stock or a stable Schwab Intelligent Portfolios allocation. The path to long-term shareholder value is entirely dependent on proving that iBuying is a business model capable of sustained profitability, not just occasional positive quarters during housing booms. That proof, which the new CEO is promising through technological and operational excellence, is what separates the current volatile stock price from the potential long-term value. Ultimately, Opendoor's value proposition has never been clearer or more contradictory. The expectation built up over the past few months is that this stock is a pure-play turnaround story driven by a management team focused on technology and margin. The reality is that Opendoor is a highly leveraged real estate business that uses technology, and its fate remains inextricably linked to the housing market and the high interest rate environment that has constrained transaction volume across the country. The stock is a battleground between short sellers betting on the fundamental difficulties of the housing sector and momentum investors and turnaround believers who are focused on the strategic reset and the high short interest dynamic. The recent dip brings the two sides into sharp focus. Investors who bought in on the AI hype must now confront the lingering specter of weak Q3 guidance. Investors should be preparing for the November earnings report now, as it will be the first major test of whether the new strategic direction can genuinely surprise the market and narrow the gap between market expectations and operational reality. Comment below and tell me your personal outlook for Opendoor's Q3 earnings. Do you think the new management can pull off a surprise, or is the weak guidance a sign of more pain to come? This will be a defining moment that determines if the year's incredible run was a sustainable revaluation or merely a speculative surge. The complexity here demands an informed, detached view, far beyond the headlines.